Hold on. There we go. All right. Let me just close the participant list. Today, we're going to wrap up the course. The main topic, actually, it's sort of a few topics. We're going to be talking about standard setting, transaction and production reporting, and inventory evaluation, which are really components of creating standard costs. And the real issue is, we looked at how standard costing has many impacts in a company. We've solved one problem of performance measurement with lean performance measurements. We solved another problem of measuring profitability by using value stream income statements. We solved another problem of analysis and decision-making by using box score decision-making. But that still leaves this standard costing system. And so the way you have to look at this is, okay, we still have this system, but we don't use it for the reasons I just explained. And what that does is it actually creates opportunities to simplify the complexity. I could even make a case for eliminating waste in standard costing systems. And that's really what I want to talk about today. But first, before we get into that, I had you do the capacity spreadsheet just so you get a feel for how capacity can be calculated. So I just wanted to walk through that for a few minutes, and if you have any questions, allow you to ask questions, okay? Let me find it. So what I did was I filled out the spreadsheet so we can just walk through it. And as I'm walking through it, please ask questions, make comments, and all that, okay? So what a friend of mine who understands lean and has a curiosity about lean accounting. I was explaining capacity to her one time, and she said, "Oh, this is just about what are we doing with our time?" And that's really a simple way to think about measuring and calculating capacity. Because I don't have a slide on this, but in lean thinking, there are 3 types of activities. And whether you're looking at a business process or you're looking at different tasks, you can categorize activities either as value added, which means from like a manufacturing standpoint, they change the form, fit, or function of the product or are the necessary activities to deliver a service. You can also look at them like even in an accounting process, what are the steps that are required to pay an invoice, for example. Then you have non-value added activities, which can be broken down into 2 subcategories. One is necessary activities. The other is wasteful activities or unnecessary activities. So the non-productive but necessary activities think of those as they're required by the business. They're required by regulations. There's a business reason why the activity must be performed. Now, it doesn't really impact creating value for the customer, but we can't, for whatever reason, we can't stop it. And sometimes within those non-necessary activities, the way they are performed, there's waste. Then you have the non-productive, wasteful, or unnecessary activities, which are your 7, 8 types of waste as defined in lean thinking. So all we're doing here, calculating capacity, is breaking down the time. So, you know, we look at sort of an average over a normal month, for example. So here we have a process where you have 15 people, 8 hours a day, 1 shift. They get a total of 60 minutes during the day for lunch and breaks, and they work on average 20 days a month. And so you convert that into minutes. Now you can also convert things into seconds if you want, but you just have to determine what the best time unit is to use. Then you look at the productive capacity, and that's based on, you know, delivering value for the customer. And, you know, the customer wants on average 4,875 units a month. Now, we also happen to do a little overproduction here of 175 more units. And you'll see where that's factored in below. The cycle time is 10 minutes. You calculate the total productive time and get the percentage, which is based on the 126,000 minutes. Anybody have any questions so far? Then you start looking at all the non-productive activities. And, you know, in a manufacturing operation, you have changeover time. So you need to know the batch size and the average changeover time. You can calculate how many minutes are spent on in a month, time spent on changeover. The overproduction, quite simple, you know, 125 units, 10 minutes a unit. Then you have scrap and rework. If you know what the scrap rate is, you can calculate the quantity and you can calculate how much time is spent on scrap. Now, in this example, there's also quality inspection time. 30% of the items are inspected. It takes 5 minutes per inspection. You can calculate the time. So what you're doing here is you're taking like various measurements of waste or non-productive activities, and you're converting it into time so you can do the math and get the percentages. There's also some downtime of 20%. And then you have a few, in lean thinking, you would call them non-productive but necessary activities. For example, daily 5S, daily huddles. And in this case, you know, 10 minutes a day are spent by each person. So you can calculate the minutes. In this example, we also factor in continuous improvement time as, you know, non-value added but necessary, 8 hours a day per person per month. And you can then calculate the non-productive capacity of almost 44%. We spend about 6% on continuous improvement, and we get our available capacity, which is just subtracting these other percentages from 1 to get the percentage. Did anybody have any questions sort of about the numbers or the calculations? What did you think about just being able to calculate capacity in terms of what it might reveal in your business. Any thoughts? You guys are a quiet bunch today. That's okay.
Yes, but the challenge is to evaluate when it's human and when it's equipment.
Yes, yes, yeah. Good point. So if you're typically, in manufacturing operation, you're going to look at capacity of the value stream. So you can do the capacity for every step in the process, or you can do it just for the bottleneck process. Now, the bottleneck process is easier because you're only looking at maybe one, maybe two steps, not the whole, not something that might be 14 or 15 steps. So that's what you do up here is you identify, there's this cell here, B4, where you identify what's the resource that does the work. So and you think about the productive capacity, is it a person or is it a machine that's doing the work, that's transforming the product? And typically in one cell, it's one or the other. So, there's a lot of machines in manufacturing operations. So you would just look at the machines. The people that work are more operators. Okay. Now they may do a few little things, but they're more just operating and moving the material around. Does that help you any?
Yes.
Okay. Anybody else have any questions on this?
Yes, maybe one more.
Oh,
and the other challenge is to figure, do you will use one shift, two shifts, or three shifts? Because sometimes we can provide support to the production line. Sometimes people are not available, like people from maintenance or planning, or so sometimes we discuss, we don't know if we take one or two shifts, but it's the other challenge for the capacity calculation.
Yeah, and so the way we explain that and other companies ask that question too, other people ask that question. What is normal? Okay, do you normally run one shift? Do you normally run two shifts? That's pretty standard in most companies. Now you may add a temporary second shift if there is a temporary increase in demand. That second shift is really more capacity, but you sort of look at what's normal, what's average, based on, and you might have seasonality issues where, for part of the year, we have a second shift, then we go back to one shift. But again, what is it on average? Because that's all we're trying to do is we're trying to understand the average capacity in terms of, the precision of the numbers. We want accurate numbers, but what we're trying to do, most important, let me just give you one example. Let's say we're doing a few improvements, and one improvement is we're going to improve quality. So we're going to reduce scrap and rework by 50%. So the 20% becomes 10%. Hold on one second. So let's say, okay, we're going to, reduce scrap we're going to improve quality by 50%, reduce scrap. Okay, we can calculate the impact there. And let's say because we're improving quality, we don't need as much inspection time. Let's say that goes down by 50%. And let's say we do some improvements and to reduce downtime. Let's say that's a 50% improvement. What's the impact? Well, if we were at that amount of capacity, we're now at this, we've pretty much created about 20% capacity through those improvements, which is measurable impact. And that's from a continuous improvement viewpoint. A lot of continuous improvement activities they eliminate waste and they create time. So how can we quantify this so that people who are not involved in the improvement activity, or executives, or any kind of executive or high-level manager, that it's easy to explain to them what's the impact? Because if I'm an executive in a company, I don't have time to understand all the details of a particular Kaizen event. I just want to know the impact. And so, okay, we did 3 improvement events and we generated 20% capacity. Okay, great. Then the question is, what can you do with that capacity? And that's where, can we sell more, for example? And again, you could plug in the number, maybe there's demand that we can meet, or maybe it's moving some resources around. For example, we have 15 people in this process. Well, can we take some people from here and put them in a different value stream? So, let's see, can we transfer 12 people? And if you go down, looks like we still can, because we're still at about 20%, we still have a lot of capacity available.
I think the one important thing here is also that you can sort of simulate to see where you should focus your continuous improvement work.
That's also a very good point. Thank you for bringing that up, because, when, continuous improvement is what's the best return on effort. So you could focus a whole lot on changeover time, but it's not that many hours. Whereas if you think about, scrap, downtime, inspection time, there's a whole lot of opportunity there. So great point. Anybody else have any questions about this? All right, so let me call up the presentation. Which I was actually looking at earlier today. So let's just, talk about these topics that I mentioned earlier. So if you think about, where we started the course and the current state of most standard costing systems, there's 3 main uses of the standard costing system: operating performance, profitability analysis, inventory valuation. And as you move on the lean and lean accounting transformation journey, the need to use standard costing information for operating performance measurement and profitability analysis is sort of eliminated. We don't need all that detailed information. But we still need it to value inventory, because quite frankly, the standard costing system is baked into your ERP system. You set the standards, you report your production, you report the products that are sold, and all that within the context of the ERP system, it moves the numbers around, it values inventory, and it posts cost of goods sold. And, quite frankly, it does a pretty good job at doing that. And so, inventory valuation is, from a lean thinking point of view, it is a non-value added but necessary activity. Accounting and finance needs to do this for the proper presentation of the financial statements. The question now becomes, how do we do it? And what level of detail is needed to do a good inventory valuation? Now, this requires a change in thinking, because the primary, you set up this standard costing system with a whole lot of details and a lot of granularity, because people want it, for variance analysis. And we want to be able to look at the variances on every job, profitability analysis. We talked about pricing decisions. So, there's a lot of need for detail. But when you eliminate that need for detail, it opens up opportunities to simplify, and you can simplify standard costing. You can eliminate some waste and still get a good inventory valuation. So what do you want to look at? You want to look at production reporting transactions. And how can we eliminate unnecessary production reporting? You can look at how you set your standards with a goal of reducing the number of rates. And eventually, and I'll say this because eventually, if you if your lean transformation reduces inventories, there's opportunities to simplify the entire way you value inventory and migrate away from detailed standards. Which
can I add something?
Yes.
Yes, because I think this is a really important point, especially, well, all three of them, of course, because we have an assembly line, and every battery we assemble, the backflush gives a journal entry of 70 lines.
Whoa.
So every item, every item is being backflushed.
Yeah.
And Jan and I are discussing this a lot, because we say we have a bill of material, a very well documented bill of material, very well documented time, and the adding of the product is done automatically.
Yes.
So what we are going to do is record all the inventory that is shipped or that is given to the assembly line. That's the actual use of material. That's what we want to measure.
Yeah.
And we can calculate what should have been spent on the back of a paper, because we say, okay, we have 20 batteries times the material used in the bill of material. That is what we think that needs to be used.
Right. Yeah.
So and you can do that on a daily basis. So I think, and we make about 500 batteries a day, so that reduces a lot of transactions in the system.
Yes. Yes.
And my point here is also that, and I've said that before, is that a lot of the times, and I think this is an issue that a lot of companies have, is that they are being tricked by these ERP consultants, and they tick every box of every possibility that is necessary or possible in an ERP system.
Yeah.
But if you think of it, you are using your system to record what you're actually using, and backflushing records what you are using in a theoretical way. But why should you record it? Because that is always correct, because you do times bill of material.
Right.
And this is also true if you're not in a standard assembly line, but if you're in a job environment, your bill of material is the main source of calculating what it should cost. Why emulate that again in your ERP system?
Right.
I think,
Yeah.
and the inventory is the same thing. If you don't use any rates, I'm just challenging or repeating what I've learned. If you don't use any rates, you just add a percentage at the end of the year of inventory or of overhead, and then the past year we have a very, very low rate only for direct labor, but the auditor doesn't even look at it because it's a relatively small number if you look at the total added value in a year.
Yep.
So, but now we are doing all these transactions 365 years a day for
Yeah.
one moment on the balance sheet. So
Yep. Yeah.
for me,
I should let you keep talking because you're doing a great job of explaining all this. You
Yeah.
really are. No, I appreciate this. It's always,
yeah, but the more I think about it, the more it puzzles me because and it's all the whole backflushing idea. It's really ridiculous.
yeah.
And there's no, but we can also do forward flushing, but that's even more stupid because you are recording your use before you even have done it.
Yeah.
So, and what bugs me the most is you have a bookkeeping system to record what you're actually using. Then on the back of on a paper pen and paper, you calculate what you should have been using based on your bill of material. I think
Right.
that's and it's not the other way around because what a lot of people are doing now, they look in the system, ERP system, and they see what theoretically should be used, and then they go all the way to redo the actual use. And there's a lot of other problems too, because cycle counting is with backflushing and cycle counting that is really hard because with the backflush it pulls away your there's a lot of sick things going on if you're using backflushing and it makes it so much more difficult.
Yes.
And so that and the analysis of your Nick, but that and the analysis of your results. I mean, management is never interested in pricing differences. Never.
Right.
I've never heard, oh, Leonard, what has been the pricing difference that past year? Never heard that. They always want to know how much did we save on the materials based on the activities we did. That's the answer you need. And you can't get it from your system if you're doing standard costing. You can't.
Yes, you are absolutely correct. No, thank you.
Sorry for this rant, but this.
This is, when I, as a CFO, when I figured this out, because basically we were operating with a very detailed standard costing system, and when the manufacturing people weren't using it, they didn't want variance information. It was sort of like I started thinking, why are we, what's the purpose of the standard costing system? That I sort of asked myself that, and I said, it's just the value inventory.
Yeah.
And so I said, okay, so how can I simplify all the work that gets done?
Yeah.
And, the only thing that matters, the individual product cost didn't matter anymore. All that matters is what's the inventory number on the balance sheet. And when you think about all the detail, that all that detail of rates and standards and run rates and details, even details on bills of material, all that is designed to sort of create the illusion of an accurate product cost.
Yeah.
But if you don't need the product cost to be accurate because you're not using it, you can basically eliminate all that detail.
Yeah.
And within accounting and finance, you can free up time, and even in operations, by reducing transactions, you free up time. When we did this, we actually, I forgot the exact number, but there were people in operations that just were dedicated to recording transactions. And when we stopped recording certain transactions, all of a sudden you can take these people and they can be used to build product, which is good.
Exactly. And may I add one other thing? Sorry, that I thought it was a personal frustration, but what happened to me is I was in a Dutch working for a Dutch factory, and there was outsourcing going on.
Oh,
and they did it, and I thought that this only happened to me, but because what happened, they started outsourcing part of production, so the overhead cost compared to the output became higher, and then we got blamed because we were too expensive. But we still had to do the sourcing, all that type. And I thought that was really sick. And I've now, Jan had the same experience in another company, and our CEO had the same experience in that. So there's also a very cynical thing about the standard costing. That's even more than just, it's even cynical in certain scenarios. And it's being misused in outsourcing scenarios.
Yeah. Anke, did you want to say something?
Yeah, just that in my company, we also have a monthly process for reevaluating the inventory based on the variances.
Yeah, yeah. Yes. And and that's this idea of, you're trying to create this accuracy, but it's, there's so many details, and we talk about this in practicing lean accounting. A product costing system is a cost allocation system. Any cost allocation system that is used inside a company by nature is the assumptions have to be made, and it becomes very subjective. And the more detailed you want it, the more assumptions you have to make. And you know what? It's virtually impossible to predict a lot. And that's why, so it creates this monster inside companies. Anybody else want to add anything before I move on? All right, so let's look at some standard setting, and the standards work to help create material cost, labor, and overhead cost. So let me just put all this up and then discuss it. So what drives material costs? It's the information on the bills of material.
Yeah.
And please take this as there's opportunity here. Okay. I'm not saying this is exactly what you have to look at, but these are opportunities that over the course of my lean accounting career, I've seen, that either I did it or I've helped companies do it. So if you think about the number of bills of material, first of all, any item that has to be reported as completed production, which is either a finished good or a subassembly that has to be put into stock, requires a bill of material. So if you think about a lean value stream, if you have created flow, those subassemblies, for example, maybe they're being made and not put into stock anymore. Maybe they're sitting in a supermarket and they're being pulled quickly to make the finished goods. So, for example, can you eliminate subassembly bills of material? Because again, if it's not really going into inventory and sitting there, you have a transaction you have to report though. So you can have your bills of material focused on finished goods. There's also, a lot of manufacturing products are custom. And there's this idea of creating this bill of material for every item, and so if you're custom, you're always building new bills of material. So there's sometimes software features and I've heard of configurable bills of material, which means the system, based on, you just report what you use, and then that creates the bill of material. You don't have to build it at the beginning. Or you can have bills of material which you can sort of substitute items. You can have especially if custom items are only changing one or two things. So there's opportunities there. Then you look at the line items. Okay, you have subassemblies. So again, if you eliminate subassemblies, you can eliminate them as line items on the bill. A lot of times bills of material in a conventional view, one of the purposes of line items on bills of material and quantities per assembly is for MRP purchasing. Okay, meaning you're going to let the ERP system tell purchasing when new items need to be purchased or replenished. So if that's the use, I've seen bills of material that have everything possible on them, meaning very inexpensive screws, nuts, and bolts and things. You put everything as an inventory item, and then it's going to automatically, kick out a purchase order. So if you have visual control of your materials, can you expense certain items, especially things that are not expensive? I saw a company that, they had screws and nuts and bolts on bills of material, or you have liquids,
Stickers.
Excuse me?
Stickers.
Yeah,
Stickers, yeah, we have them also. Yeah.
You're using, you're using a liquid, and the quantity per assembly. I mean, how much paint are you going to use? There's an element of a guess. And so the idea is, with visual control of your materials, the visual controls can signal purchasing when to reorder, because that's what a Kanban system is. Exactly. And so there's the opportunity to simplify your bills of material.
Yeah, can I make one?
Yes.
Yeah, for quality purposes, in our case, but it is also with other, you need a bill of material with everything on it for quality purposes, because that's the nature of our product. But that doesn't mean you need to have it on the bill of material used by the ERP to make this backflush journal entry.
Yeah.
Because that is, I've had that discussion too. Our engineers say, yeah, we need a bill of material with everything on it. And I fully agree. We also need it as finance, because that's how we calculate the cost of a battery, and we calculate the expected margin. But it's different than using this in your ERP system as a basis for your journal entries. And that's what's being used, because in our case, we have like 4 items that make 80% of the value, and the rest, I say, get rid of it and expense it and buy it via Kanban, or have the supplier supply it based on Kanban. But because if you don't want to get into that discussion, because I've had that discussion a lot, they say, yeah, we need a full bill of material,
right?
And I understand that. And that's true for assembly, and that's true for a job order, but don't use it in your backflushing system. That's
right. Yeah. Did somebody else want to add something? Okay. Then the last item is price. What is the price of the item that's on the bill of material? You can spend a lot of time using standards or calculating standards. You can also move to either last price paid or just an average cost. A lot of that is many times that's just like a system configuration. It's like, just, I want to use average cost. And then you don't have to worry you don't even have to worry too much about calculating the standards or guessing,
Yeah,
You know,
sorry. That is, I think, one of the best features of an ERP system, to calculate automatically the average price, because
Yeah.
that makes we will not do it in the last month of the year because we are not completely sure that everything will go. But as from January, we will go to average price,
yeah,
because that makes that eliminates two lines on your trial balance that you don't understand, that it's a valuation or pricing differences, for example.
yeah.
But that nobody can understand pricing differences. Just use effort, and that's something where an ERP system can be very helpful.
Right. Yeah, good point.
One of the few instances.
Yeah. So if you look at labor and overhead rates, and let me put everything up here, then have a general discussion. You know, there's two factors. You know, there is the actual rate, and to get a labor dollars or labor cost, it's a rate multiplied by time. And then you get that labor cost and you multiply it by an overhead rate to get the overhead cost. Again, you need a lot of details if you're pursuing an accurate product cost. But if you're not trying to pursue an accurate product cost, so you can reduce the number of labor rates, the number of overhead rates. I would say the goal would be like one labor rate in a location, one overhead rate in a location. That's the goal. But any reduction you can do is good. I mean, we did some work at Boeing about 10 years ago in their commercial aircraft division. They had 500 labor rates and over 100 overhead rates. And they actually reduced it. They reduced it down to like less than 50 labor rates. And that was just the first effort, and they got it down to like 6 or 7 overhead rates. So it's just that, because they realized also the complexity that this was creating. So that takes care of just the rates. And then you have to look at the time piece, okay? And that gets into the idea of, the production steps and what's called a routing or a router, which is the production steps that are on a work order. And so again, seeking detail, you want to have the time for every production step for a product. You can even try to get time for every production. You can also try to get rates for every production step. But again, if you have visual control, and if you're flowing faster, then you can reduce the number of production steps. The idea would be to have, the goal, one production step, make the product. You release it, you make it, and then you close it. And then you don't have to worry about all the times, all those detailed times, because you also want to stop reporting actual to any production step. I'm going to talk about that in a minute. So again, fewer production steps on the work order or in a router for a product, and fewer rates. Again, we're not concerned about variances on job costing reports. We're not concerned about overall variances. We're not concerned about overhead absorption. Then you look at the transactions, which primarily focus on work orders. Let me just put these up. Okay. A work order does a lot of things in a system. It initiates production. It tracks production. You close a work order that reports completed production. The work order accumulates costs, time and material. It values inventory. It creates variances. It also, and sometimes work orders include work instructions. So there's lots of uses for the work order. And this is, again, it's an opportunity. You have to look at the uses of the work order and determine, do we have something in place that eliminates the need for the use of the work order?
Yes.
So if you use work orders to initiate production, and sometimes MRP generates the work orders, if you have visual production control with a pull system, do you really need all those work orders to tell people what to make next? Okay. In which you can reduce the number of work orders to match sales orders, for example. Reporting production. Okay. All we're trying to do, what is the one purpose of a work order for inventory valuation? Can anybody tell me that? It helps value inventory, but what does it do in a system?
That beats me.
It takes the raw materials, it converts the raw materials into a finished good, and it applies production costs, labor and overhead, all done at standard. Okay. And, there has to be a way in an ERP system, there has to be a way to get the finished goods to the point where you can invoice them in the system and you can actually physically ship them out the door. And so again, how many steps do we have to report production on? And that's this idea of, the one definition of backflushing, which I've read, is, it's just about moving whatever is set up as standards. It's about moving those standards through the ERP system. So again, fewer production steps. The idea would be 2, open and close.
Yeah, even then, Nick, because I had the discussion too. I said to the people, why don't you just start building? Why do you need a work order? Because you make a production planning for the week and you start building them.
Yeah.
And then you start recording the use of your material, because you start recording the actual use, and then you report the finished goods.
Right.
And people were looking at me, and now we work without work orders. We just start with building stuff.
Yeah.
And
Too big a
of
change.
course we have a good manufacturing execution system, so that system that creates a number, which is attached to the item, and that follows the process, and we record every we record for example the material that is needed to be recorded to that assembly. But you don't need a work order to start working, and a lot of people think you need a work order to start working. You don't need a work order. You need a plan for the week, for the day, or for the hour.
Right.
And then you put that on the board, and then you just start.
Yeah,
and
you're absolutely right. I thoroughly agree with you. You don't have to have that work order.
No.
And but again, that's the whole idea. Can the work orders operate in the background, maybe automatically somehow, where people don't need them? So yeah, there's again tremendous opportunity here.
Yeah.
And I will say, I really want to compliment you. It takes in companies that have standard costing and ERP systems, it takes people like you to challenge the way you just explained it. Why do we need a work order?
Yeah.
And people
they start looking. They start looking very odd towards you, because
yes.
that's how they've been working for 20 years.
Yeah, I know.
But what I think is important, that at the beginning of the week or the day, you talk to each other and say, what are we going to do today? Are we going to build a machine? We're going to assemble a battery. We're going to blah 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 blah.
Yeah.
And yeah, so and the funny thing is that once you eliminated it, nobody asks about it again.
Right.
That's also very
Right.
interesting.
Yeah. And so, you know, lean inventory valuation is another opportunity. I mean, you have to get your inventories down, but you don't, again, and this really gets into labor and overhead rates, okay? And capitalizing labor and overhead by product the way a standard costing system does it. The rationale behind it is you're moving to average cost, okay? That's sort of whether it's generally accepted accounting principles or IFRS, that's what you're moving to. So, you know, what do you do? And, you know, we need to know what our actual costs are. And we have them on a value stream income statement. And if our inventories are relatively low, 30 to 60 days of inventory, those actual costs represent the actual production costs for the period. And so all we want to do is understand what portion of those actual production costs, which are on the income statement right now, need to be put on the balance sheet so that inventory is valued properly. And this can be done with a journal entry. I've done this and I've helped companies do this. The benefit, you set your labor and overhead rates to 0. And you can keep material in, but and when you set your labor and overhead rates to 0, by the way, you don't have any more absorption, you don't have any more variances, and all the financial statements look cleaner. You want to get your auditor help on this. And I have never encountered an auditor who does not support this. That what they want to do is they want to be able to test it if you're audited. That's their whole reason for having an interest. So here's a simple example. We have our actual value stream costs. So we're going to use days of inventory. Okay, so there's 20 days in a month. We have total material cost of $849,526. We have total conversion costs, which are the actual production costs, of $876,550. And then we know how many days of raw material we have, how many days of work in process we have, how many days of finished goods we have. So if we calculate material cost per day and conversion cost per day, which becomes an average, then we just simply take those average costs, multiply it by the number of days of each category of inventory, and we get an inventory value of $963,148. If the beginning inventory was $118,635, we simply make a journal entry to take that $222,887 from the balance sheet back to the income statement. You're done valuing inventory. Any questions?
Yeah, I'm curious about it. When you've done this in companies, how much does it differ?
You test it. Well, what you do is you practice, you test it out. There's different methods, okay? And you sort of have to do it. And I mean, you don't, the last company I worked with is they had a difference, but then they worked through it with their auditors, what that difference was. And they realized it was going to be like just a one-time adjustment, and the auditor said, okay, and it wasn't that material. So they let them do it, and they started their new method.
Yeah, can I add? Because what happened to me is the auditors ask me, is your overhead rate correct? And then you make a similar calculation to like this, if the absorbed cost in your overhead or in your end product is correct. You say, okay. And then in the end, I thought, well, why am I doing all this absorption? Well, the only thing the auditor is interested in is this calculation that you just showed.
Right. That's all they care
Because,
about.
yeah, if you give them this sheet and you tie it to the balance sheet and you say, okay, this is the material, this is the overhead, and you give them this sheet, you're done.
Yeah.
Because what happens is you spend a week trying to understand what is absorbed by doing all these crazy calculations, and in the end, this is the truth, because this is actually what's happening.
Right.
So for me, it was the other way around. I did this to check my overhead and then absorption, and I thought, well, this is it. So just stop all the other transactions.
Yeah. What got me thinking when I was CFO is I saw how much time the auditors spent testing the standards.
Yeah.
And then when I approached them about this, it was like, yeah, we'll do it. And I even told them, I said, I realize you're going to spend less time testing standards, but I'm not going to ask you to reduce your audit fees. I said, because you're helping me out also.
Yeah.
And they, in generally accept, one of the misconceptions is that standard costing, nowhere in accounting regulations does it say you have to use standard costing to value inventory. It never say that. What it says is accounting must be at actual. And that's what auditors are testing. So I need to wrap up here. So practical advice, lean inventory valuation is company specific. Okay, you have to look at your issues. The main piece of it is how you capitalize the production costs. Do it at a macro level, not a micro level.
Yep.
So just to wrap things up, and we talked about the problems. Okay, we want to using standard costing information to measure operating performance just doesn't work. Okay, I'll be honest. Okay, it's in a lean company. And you have to deal with standard costing, okay, in the ways that we talked about throughout this course. So the more that you can separate your management accounting system from your inventory valuation method, the better you're going to be. And that's what I tried to get through in this course is create that lean management accounting system. Then you still have inventory evaluation. In the short term, if you still have to use standard costing, that's fine. In the long term, you may have opportunities. Well, in the short term, you have to use standard costing. In the short term, simplify it. In the long term, maybe you can sort of turn most of standard costing off. This was one of the first slides I showed. And, I just wanted to sort of wrap this up that, we have the tentacles of standard costing and how they're being used. You have to sort of look at this from a series of problems, not just one problem, and work through problem by problem. Focus on performance measurement and profitability first, then you can focus more on the other side, setting standards and reporting production, inventory evaluation. In the long run, you change the role of accounting and finance. Okay, I actually have to get onto an education class. Anybody have any final questions, comments? I thoroughly enjoyed having you. I'll send out the video with an email later today. Remember that you have those assessments. If you'd like to discuss those assessments one-on-one, we can set up a session. If you just have a general discussion about standard costing in your company, please, contact me and we can do a one-on-one session. There is no time limit on when you schedule that one-on-one session. It's an open offer, okay? Anybody have any final thoughts?
Yes, if it's possible to you to send us the example of capacity Excel file that you show us at the beginning of this session.
Yes, I will send that to you.
Okay, thank you.
Thank you.
Okay. All right. So thanks a lot. I enjoyed having you.
Yeah,
Thank you.
Let me
Thanks a
stop
lot.
sharing.
Thank you, Nick.
keep in touch.
Appreciate it.
Hope to see you in the
Speak to you
future.
soon.
Yes, thank you.
Bye-bye.
Bye.
Bye.
Bye-bye.